Hello, I'm Emily Bellet, the founder of Vestpod and author of You're Not Broke, You're Pre-Rich. Welcome to The Wallet and our 7-episode mini-series where we take your most pressing questions to financial advisors. Taxes. That word alone can send shivers down your spine. But today, with the help of chartered financial advisor Lisa Conway-Hugh, we'll try and make taxes a little less scary for you. Lisa provides valuable insights on avoiding common mistakes, staying organized, and ensuring you have sufficient funds. Lisa shares her expertise on tax-efficient saving and investing, pensions, and the art of gifting. Join us as we explore how to navigate the often anxiety-inducing process of filing tax returns, while gaining a fresh perspective on effective financial strategies. I'm often asked, how do I find a mortgage broker, financial advisor, or an accountant I can trust? In a world full of chaos and noise, it can definitely be tricky to know where to turn. This is where Unbiased comes in. Unbiased is a matching service that helps to connect you with the most experienced and regulated experts. Essentially, they do the work of finding the right expert person for you. And the best bit? It's free to use. Visit unbiased.co.uk today and find your match made in money heaven. Remember that we are not certified financial advisors. Information shared in this podcast is for educational purposes only and does not constitute financial advice. Can you explain, how income tax works as well as tax brackets?
Yeah, sure. So the first thing, and it sounds like jargon, but the personal allowance. And so the personal allowance is the amount that you're allowed to earn tax-free. And so for most people, that's just over 12,500. But you can see the exact numbers on the graph, but just over 12,500 to keep it simple. So you pay 0% tax there. And then all the earnings between that bracket and then just over 50,000, that's the basic rate tax bracket. And there you're paying 20% on that slice. So if you earn 49,000, you've got some in the 0, some in the 20. Then between 50 and 100,000, that's the high rate tax bracket. And that's where you're going to pay your 40% tax. And then I always call it the sneaky tax bracket. And it's the bracket between 100 and 125,000, where you pay the equivalent of 60% tax. And so many people who are in that bracket don't even know they're in it. They just know that their tax code keeps changing and they never get the amount that they feel they should. And the reason for that tax bracket is for every pound you earn over £100,000, you lose 50p of that personal allowance. So when someone's earning 125,000, they have 0 personal allowance. It all shunts down and it creates this 60% tax bracket. And then once that 60% tax bracket's finished at just over 125,000, then it's 45% tax. That was a big change for this tax year because it's starting much earlier, that 45% tax bracket.
So how do you discuss with your client moving into like a higher tax bracket?
Well, I think key things are, so I had a lady yesterday who is going to take a jump from the late 80s as an income to 130. So that's a really nice jump.
That's amazing.
It was, and I was like, but do you want to know the bad thing? I was like, the tax man's going to take loads of it. So she only ended up with just a little bit more than £1,000 a month extra.
Wow.
Once we're going to have to do her pension planning for everything over 100. So you've just got to be careful that if you're opting for more hours at work or you're going for a pay rise, actually use a salary calculator online. Literally just Google UK salary calculator and see what the impact of that pay rise is actually on you. Because some of my clients actually, especially in that 60% tax bracket, you could be better off emotionally and not that worse off financially by, say, going down to 4 days instead of doing 5.
Once you're in this bracket, you know exactly how you earn, what's your net salary, what are some common, tax deductions that are allowed that people often overlook?
The big one is pensions.
Yeah.
So if I was earning 110, I put 10,000 in my pension. Because of the 6% tax, it's actually costing me 4,000 a year. And that 6,000 is going to come back from the tax man. If I was earning 55,000, if I put 5,000 in, it's going to get all my high rate tax back, and it's going to reinstate me as a basic rate taxpayer. And that's really, really important, especially for parents, because it means that you start to qualify for all of your child benefit and things like that. So pensions is a big one. Don't forget to claim for professional fees and subscriptions. You can put those on your tax return. Charitable donations, they're really important, especially if you're a high rate taxpayer and you've ticked that gift aid. The charity's going to get tax relief at 20%, but you pay 40% tax, so you're owed some money back. So putting that on your tax return is going to really help. And then this one I see far too often. Most people pay their pension at work as a salary sacrifice. So the money goes into the pension and then they pay tax on the rest. But a lot of pensions, especially if you're in a smaller company or you're in something like People's Pension, for example, it'll be done as relief at source. So the money goes in, you get your 20% tax relief. But if you're a high rate or additional rate taxpayer, you're actually owed more money back. There's so many times I've seen that. So a really clear question to ask your HR is my pension relief at source, and do I need to do a tax return?
And now if we talk about some mistakes that people make, because people are really worried, and I'm worried. I mean, when I, doing tax returns is always quite stressful. What are some mistakes that actually people make?
I think a lot of people don't realise you have to pay tax on savings. So they forget to put their savings interest on their tax return. So everyone has a personal savings allowance. So if you're a basic rate taxpayer, so earning under that 50,000 threshold, you're allowed to make £1,000 a year in interest. If you're a high rate taxpayer, you're allowed to earn 500 a year in interest, and then above that, it's you don't get a personal allowance. It's all taxable. So I think putting those on. I also think people forget to use their capital gains tax allowances. So that's really important. If you get given shares at work, is to sell down each year to make sure that you're using that capital gains tax allowance. It was 12,000 last year. It's 6,000 now, and it's going to be 3,000 next year. So it's a increasing tax burden there. And then I think doing it in a mad rush. The 31st of January is the deadline, not the target.
And I heard it's the busiest day on HMRC's website, actually.
There was a really sad statistic, which I really can't remember, but of how many people actually do it on Christmas Day.
Yeah.
I think try and do it April, May, June time. Try and get it done before your summer holiday, because HMRC are not busy at this time of year. They probably start to get really busy again in October when people do the paper versions. So over the summer months, they're not going to be as busy. So if you've got questions, then you can call them up. They will help you.
They're super helpful.
And what I do, so mostly now things come through electronically. So I just have in my email, I just have a folder that when something comes through that's tax related, I put it in that folder so it's all in the right place. When things come through post, like interest statements and things like that, I just keep an envelope by the door, put the stuff in as it arrives. And now is the time that it's going to be coming out. So just keep everything, make it as simple as possible for you. And then don't forget, if it's just too much of a headache and it causes you too much stress, a couple of £100 to do a tax return for an accountant might be worth it.
And can you remind us of the dates for tax returns?
Yeah, so the deadline's 31st of January. So we're in the tax year now, 2023-2024. So that's going to end on the 5th of April. And then you have to do your tax return sometime between the 6th of April 2024 and the 31st of January 2025. But if you just get it in your head, as soon as the tax year's over, I'm going to get this done, I think it doesn't need to drag on. It doesn't need to ruin your New Year's Eve.
I was speaking to a few of our freelancers, and they were asking, if you've just gone self-employed, what advice would you give to someone who actually never filled out a tax return before, and how you get organized a little bit, because you'll also have to pay this tax bill at some point.
So I think the thing that can catch people out in their first year is that payment on account. So it always feels like you're chasing your tail. So payment on account, let's say I have to pay £10,000 in tax in my first year. Halfway through the following year, I'm going to have to forward pay half my tax bill, so 5,000. And often you're not prepared for that. So I think being prepared for that first payment on account. And that is also magnified. If you have a really good year and you take a jump up, your payment on account is going to reflect that the following year. So just be prepared and forewarned with that. I think if you find it quite stressful and it's all very new, maybe for the first few years, do get an accountant to do it for you. Or maybe think, should I just always get an accountant to do it for me? Because the time I spend trying to do it could be time I'm actually making more money than the tax returns costing me. I also think you need to, most people do their tax returns on a what did happen scenario, whereas now we're sort of a quarter in, are we? May, June, July. Yeah, we're sort of a quarter in. It'd be good to break the tax year down into quarters and just say, well, how's my first quarter gone? Am I ahead of schedule? Am I behind schedule? Does it look like I'm going to break any of those thresholds? And if so, should I be putting more aside for pensions? So I'd definitely start pension contributions. We know there's a big problem with the self-employed and not having a pension. So I do a monthly that you can always manage to pay in, and then February, March time, do another sort of check of what does it look like, where might I finish, and then do some pension planning to try and control which tax bracket you're in.
Yeah. And that's definitely, I mean, for us, like, working with an accountant, if you're a director of a limited company, for example, and you look at your profit and you see this, corporate tax, maybe thinking about, some of these tax allowances and pensions, is really smart. But it's better, as you say, to do it on a quarterly basis rather than stressing out, a week before tax return and the tax is due, because then it's too late if you don't actually have the cash on your account.
And I think if you just put it in your diary, a little sort of meeting with yourself, half an hour, a quarter, I think it will be worth the time spent.
And what about, you've done your self-assessment tax return, and now you owe money to HMRC, and you realize I actually don't have the money. What's the best strategy? I
think now it's going to become increasingly the problem. So I think the first thing is you've got to be open with HMRC. You've got to respond to their letters. That's going to really help you make sure you're not getting fined. They have a system called Time to Pay, which means if you get in touch with them, they can set up a payment plan. They'll look at what's coming in, what's going out, and often they'll want you to be paying them back at least 50% of your disposable income. So it will be affordable and sort of adjusted to your situation. But I think the sooner you deal with it, the easier the problem is.
And do you have some like saving strategies that people can implement? You discussed a few already around savings, around pensions. Anything else that we could do?
Don't forget the ISA allowance. So you would usually, this year maybe not, but you would usually expect your investments to grow more than cash in the bank. So I always see people with cash ISAs, but they're forgetting that allowance might be better used in their investments. But either way, you get £20,000 a year to use in an ISA. If you're married, and I say married because if you're just living together, there's no protection if you separate. Mm-hmm. If you're married, you want to keep all of the taxable stuff in the lowest person's name. So if one of you is a high rate taxpayer, one of you is 20% taxpayer, you're going to want to keep savings that are taxable in the lowest taxpayer's name. Whereas pension contributions, you're both going to want to have your pensions, but overpaying into pensions, you're going to want to do in the highest taxpayer's name. So you want to get that balance right and sort of be taking advantage where you can. I mentioned it earlier about capital gains tax allowance. Don't forget to take advantage of that every year. Another thing I see all the time is if someone's lucky to have a buy-to-let or a second home or holiday home, and it can often just be in one person's name. And again, if you're married, it might be beneficial to split that. You can do something called an interspousal transfer so that you own it together, or in fact, can the lower taxpayer between you own more of it? The same goes with work shares. So really be on it with your work shares. And don't forget that if you're, especially I see this all the time in the tech world, if you're getting a salary, a bonus, and then you're getting given shares, don't forget that's really going to impact the amount of tax that the amount that you're earning, and therefore the tax that you're paying. So being on it with the shares is really important. You can also do interspousal transfers of shares to your spouse. So you can be using capital gains tax allowances all the time. The personal savings allowance, which I mentioned already, again, a lower rate taxpayer is going to have twice as much of an allowance as the high rate taxpayer. Then check your tax code. So most people have a tax code which is 125L, and all that stands for is the 12,500 and a little bit that you're allowed to earn tax free. So if I had an 11.5L, it would mean actually I was only allowed to earn 11,500 tax free. So just make sure your tax code is right, and just cross check it with a salary calculator. I see that quite a lot actually. Marriage allowance. So again, you can tell that quite a lot of these tax saving things are geared up to being married, which hopefully is something the government will change. But I think the Conservative government, well, at least under David Cameron, did make it quite clear that these were for married couples. But anyway, a marriage allowance is if one of you earns less than that 12,500, so you're not using all your personal allowance, and the other person is earning less than 50,000, so it's a basic rate taxpayer, you can give 10% of your personal allowance to the other person, just so that means they can earn more tax-free. And then I think it's about, I suppose I feel like a stuck record, so I hope this isn't too boring, but it really is about pension planning and using pensions to try to dictate your tax threshold.
And we'll have an episode in this series around really like investing and getting into it. But yeah, for anyone, especially if you're freelancer, business owners, and you haven't thought about pensions, maybe it's the time to look into it. And you mentioned, Lisa, that working with an accountant can help you figuring out your taxes. Can you tell us a little bit more, who can help you in this journey? So, you're a financial advisor, and maybe have a broad idea of costs. That would be brilliant.
Often the sort of perfect trio would be having an accountant, a solicitor, and a financial advisor all working together to make sure that your needs are maximized. But I mean, a lot of people don't have the money or need that much care. But I think when you're looking for an accountant or a financial advisor or anyone that's serving you, they've got to speak your language. So don't just assume all accountants are boring. There are accountants out there that will speak your language, that will take the time to help you understand it. Because essentially it's in their interest. If they're helping you learn about tax, or financial advisors helping you to learn about investments, over time you're going to understand more, and eventually you're going to be a much more informed and therefore an easier to manage client. So don't forget you're paying them. So shop around, find someone that speaks your language. Maybe speak to friends and see if they've got a recommendation. But I know there's loads out there. I often do a talk on my Instagram with an accountant who I think is brilliant. So you can see all that on there.
Brilliant. And we're organizing a webinar also about financial advice and professional services on the 20th of July. So definitely, you should sign up. You mentioned child benefit earlier in the conversation. Can you tell me for women specifically why this is important and what can we do?
Yeah, so child benefit is you get £24 a week for your eldest, £15.90 a week for kids, for second and onwards kids. If you earn over 50,000, well, let's put it this way: if you and the child's other parent earn less than £50,000 a year, you're allowed to have the full child benefit. If one of you earns more than 60,000, you aren't allowed any child benefit. And then you are allowed some child benefit on earnings between 50 and 60,000. And it's important, even if you are a higher rate taxpayer and therefore you're not allowed the child benefit, if you're working from home or you're on a low income, so you're not qualifying for national insurance credits, it's important to claim it, believe it or not, and then give it back. Because when you claim child benefit, if your child is less than 12, you get national insurance credits. And to be able to get the full state pension, you need 35 years of national insurance credits. So every little helps. So making sure you get those is important.
Thank you so much. And finally, I have a question about gifting. You mentioned that as a way also to reduce your tax bill. Can you tell us how gift aid works? Because that can be complicated sometimes.
Remember to yourself which tax bracket you're in. So are you in the 20, the 40 or the 45? Then when you tick gift aid, so say you gave £80 to charity, the taxman's going to give £20 to the charity on your behalf. So the tax relief you've paid also goes to the charity. Now, if you're a basic rate taxpayer, that's the end of the story. If you're a high rate taxpayer, you've paid 40% tax, but only received 20. So if you put in 80, the government tops it to 20, but you're owed another 20 back, because you want the end result to be you've paid 60 and you've had 40 in tax relief. So the whole thing adds up to 100. Shall I say that again? So if you think about as a high rate taxpayer, if you earn £100, 60 comes to you and 40 goes to the government. If you do £40 to the in charity, you get 20 going to the charity. So we've got this 80-20 split, but we need that split to be 60-40. So the government owes you an extra 20 to get that back to that 60-40 split that we want. And 45% taxpayers get that little bit more as well. So yeah, you just need to add on your charitable giving into your tax return every year to make sure that it's rebalanced for you.
Brilliant. Thank you so much, Lisa. Any final tip on taxes? Any words of encouragement for people who can be really stressed out about getting started?
Yeah, you're not going to jail unless you're really bad. So I think just embrace it, because we are taught to fear taxes, but actually Inland Levy is there to help you, financial advice there to help you, accountants are there to help you. It just doesn't need to be a sort of an ostrich moment.
Thank you for tuning in to this episode of The Wallet. We understand that discussing money can often be viewed as taboo, but we strongly believe in the value of sharing knowledge with friends as a meaningful way to give back. Be sure to click and follow The Wallet on your preferred podcast platform so that you don't miss episode 5, which will be airing next Thursday. In this episode, we'll be looking at money and well-being, exploring why we often equate money with success, and examining the connection between money and happiness. If you enjoy our show, we would greatly appreciate your support by leaving a 5-star review on Spotify or Apple Podcasts. Lastly, make sure you mark your calendars for upcoming live webinar on financial advice on July 20th, where we'll be exploring the ins and outs of working with a trusted advisor. You can sign up for free via the show notes or on Vestpod.com.